Are you sitting there with a small trading account thinking to yourself, I'm never going to have enough capital to trade on the big expensive stocks? Well, if this is you, in this video, you're going to see an easy way that you can use a specific options trading strategy to make moves on the expensive stocks like a Netflix, a Meta, and more. And no, this is not going to be about buying cheap call options and hoping for the price to skyrocket. There's just way too much risk in that approach. With this strategy, you will actually know your odds of success before making the trade, and it can be upwards of 80 to 90% per trade, depending on how much risk you actually want to take on. Just to clarify again, this video is perfect if you have $5,000 or less in your trading account. And most trading platforms will make you put in 2,000 bucks into your account in order to trade options, what's known as a margin account. At least that's the setup that I have when I trade with Interactive Brokers, so I'm going to assume it's the same across the board. So, how do you trade on these expensively priced stocks? Netflix is 900 bucks a share. Meta is hovering around 600 right now, and even Apple is pricey at over 200 bucks per share. With an account of 2K to 5K, you could buy a share and hopefully the price goes up. Or you could go the call option route and buy some super cheap call options with the lottery kind of winner mentality, which has really, really low odds of success. So, what we're going to do is just take both those ideas, throw them out the window into the garbage. And there's a better way to do this with a small account to limit your risk while still giving you a chance to have some profits in each trade. Enter what's known as the credit spread. This options trading strategy allows small accounts to trade the high price stocks. And first, I'm going to explain how it works. Then I'm going to show you an example trade in real time. You're going to see how to find your odds of success and to figure out the most you can lose in each trade or your max loss. Plus, at the end of this video, there's an added bonus with credit spreads I'm going to reveal, so stay tuned for that. So, how do credit spreads work? Well, it involves selling of an option and buying of an option. We're going to start on the put side of our option chain and say, hey, we want to sell a put at a price that is below the current stock value. And we're going to also buy a put one level beyond that. And basically, the way it works is if you have a stock that you sold the put on, you bought the other put below it. If the stock price stays above the price of the put that you sold on expiration date, you're a winner. You win your maximum amount. And the maximum amount is the premium that you get overall when you open up the trade in the beginning. So let's look at an example right here with Apple in our Interactive Brokers trading platform to show you in real time. We are coming to you live from the Interactive Brokers Trader Workstation platform on a desktop computer, and we're going to go into our options chain for Apple right here to blow this up and show you how the credit spread works. We've got 31 days out till expiration in this example, which is perfect. We've got Apple going here, calls on the left, puts on the right, like most option chains show. The current price of Apple, 213.96, flirting with 214 right now, wants to get up there. And so what we want to do is focus on the put side, and we want to make sure that we sell our first put below this 213 value. So what I'm going to do here is just go down and put the strategy builder on, which allows me to make an options trade that has more than one leg. So I'll go in here now and go the 200 put. So that's below the 213 price of the stock. So 200 is the put that we're going to sell. I'm going to come over here and sell this leg. That's going to fly into our kind of strategy builder down here. So sell this leg. 200 is lower than 213, which is perfect. That's what you want to be when you're doing this on the put side for a credit spread. And we want to buy the next put down. So that's that 195 put right there, going to be blue to buy. And now you can see here we have a combination trade, an April 17th expiration, a 200 strike, 195 strike bull put. We're going to sell the 200. We're going to buy the 195. What this gives us is a credit right here of about 77 bucks. We got 77 bucks of profit for making this trade. Don't worry, the best is yet to come. And a bit earlier, I talked about knowing your odds of success before making your trade. So if you have better odds for success, you should be able to make more winning trades, which means you should have a better success rate in your account and make, hopefully, more money. So here's how you find this with credit spreads before you actually make the trade. Now we can lock in the $77 of credit. And actually, if I go in here and look at this, the market's kind of moved while I've been talking about this. So it's actually closer to 88 bucks right now that we could get. So 88 bucks is on the table. But before we do this, we want to know our odds of success. So to do this, there's two ways. And the first way is to go into the advanced tab right down here, the plus button, open this up. margin performance. And if you have a similar type of platform, it's going to give you some kind of performance details. And the big thing you want to look for over here is the profit probability right there at 79%. So we have almost an 80% chance of being profitable in this trade, which is a hell of a lot better than buying call options or just buying shares outright of the stock and just waiting and seeing if the price goes up. And that really is the golden goose for small accounts. You want to minimize your risk like this as much as you can and still get a decent return on your capital. So with an 80% win rate here, maybe you want to make this trade and transmit and put it in the hopper. The other way to do this, I'm going to close this down right now, is you can just very simply look at your delta. And your delta is an option Greek here in the options chain. What you can see here, roughly back of the napkin, you can see if you have this delta right here for the 200, it's at negative 0.232. What that number is telling you right there is a 23, roughly 23% chance today, right now, live, that the price of Apple will end up under $200 per share at expiration date 31 days in the future. So if you want a very quick gauge of what your delta is, you can look at that and say, okay, I've got a 23% chance of losing this trade or having to take a capital loss on this trade. Again, it's very back of the napkin. If you want to get like the nuts and bolt detail, go into that performance profile I just showed you. But that's another quick way to do it, just at a glance. So again, if you want to put this guy in the hopper, right before we do that, we're going to go margin performance one more time and just show you the other thing that's important to know is the max loss. And the max loss is shown right there underneath the max return. It's in red because it means it's bad. You don't want that to happen. But hey, sometimes it does. So we want to make sure that we understand our risks before going into the trade as well. And again, the big thing with small accounts is minimizing risk as much as we possibly can. So a max loss of 400 bucks is a lot easier to stomach on a $5,000 account versus losing 1,000 bucks or 2,000 or having half your account wiped out. So you want to give yourself more chances to be in the game and make winning trades, and making your max loss a fraction of what it could be trading in other methods, buying calls, buying shares, is another way to minimize your risk. And you don't even have to accept the max loss scenario in this trade. Like, this is what the worst case scenario is, so it's good to know. But you can actually put a stop loss on and make this $100 or $200 if you wanted to kind of keep it a bit more subdued. And to do that and see how to do that step by step in Interactive Brokers, check out the video linked right there. That's going to walk you through it step by step for a stop loss on a credit spread to help protect your downside risk. And the way that we calculate out that 417 value is very simple. We have our calculator. We've got a 200 strike that we're selling. We subtract 195. We multiply that by 100 because each option contract is worth 100 shares. And then we subtract the premium or the price that we're going to get paid to sell this credit spread. So let's take away $88. And we're right around that 417 number, 412. There's some rounding and there's some commissions kind of baked into that as well. It's going to be pretty close though. That's your max loss scenario. That's how that's calculated. You take the strike that you sold, you subtract the strike that you bought, and then you subtract your overall credit that you're being received. Make sure you multiply by 100 to get the actual amount and value that you're going to be trading and receiving. And I'm actually going to put this one in the hopper right now by clicking transmit. And there it is in our hopper right there. We have an order. It hasn't actually been executed and filled yet, but once the trade gets matched up, it'll go into our account and we'll be able to manage it moving forward. And this is what it looks like when they are in your account. We've got some credit spreads in here, a bull put credit spread at the top, another one down here. One of them's not profitable right now. One of them is. So just some examples there of how it looks once it's actually in your account. Okay, you've seen how a credit spread gets layered and put together. Now for the exciting part. You can use a credit spread if the market is moving higher, using the same example that we just showed with the put side, or if you think the market is going to be bearish and drop, you can use a credit spread on the call side and profit from the market going down. How wild is that? Here's a walkthrough on Apple again, showing you how to use it. If you think the market is going to go down, you can use a call option credit spread to profit in that scenario. So we are going to open up our options chain again and focus on the call side this time. And in the call side, we are doing the exact same thing that we did on the put side, except we want the first strike price to be above the current price of the stock. And we don't want the stock price to go above that. So let's look here. Let's go down to the 230 strike price. We're going to sell that one. And then we're going to go ahead and put our strategy builder on to build out the trade and sell the 230. We are then going to go ahead and buy the 235, so one higher or one further away from the current price. And now we've got a bear call credit spread where we're going to get paid about 70 bucks, which isn't too bad. We're going to go into our advanced tab right here. And we've got a 80% chance of winning this trade. Max return of $70. Pretty good odds, pretty good return. Max loss again of 428. So about that kind of 415, 420 area, which is makes sense because our strikes are both $5 apart on either side. And if we want to do this trade, we can do the same thing. Transmit this guy, put it in the hopper, and then close down our options chain. Now we can see that we have our activity orders.
Order filled.
We've got our bear spread filled and our bull spread still waiting to be filled in there. So we may have to change the price sometimes on these to get them filled, which is easy as going in, clicking the price, going to the mid, and clicking update to hopefully get that one filled. Easy enough. But those are the bear spread, the bull spread. Both credit spreads can be used again when the market's going up, when the market's going down. And from that point on, it's just a matter of figuring out what kind of odds you want to have for your trade and slowly growing your account over time with a bunch of wins. And remember, credit spreads allow you to trade super expensive companies even with a small account size, but you can also use them on lower price stocks the exact same way if you want to. Make sure you subscribe if you got some value here today. And if you want to find stocks in play for small account trading, check this out right here.